Have you ever, while you walking on the street, suddenly Donald Trump appear and say, "Give me your money"? Probably not, because you're unemployed and know nothing about tax. But have you ever making small money and still have to pay a lot of tax? And you hear that a lot of billionaires are not paying any taxes. And you wonder how the rich avoid paying tax without getting arrested. Don't worry, I will tell you how the rich avoid it. And also, I will explain it to you in an easy way, a Minecraft way. This is Steve. Steve have emerald, like a lot of emerald. And he didn't want to pay his taxes, just like you. And he really wanted to become one of those billionaires because he wanted to live like a king and not paying any tax to the government. But when he tried to avoid paying tax, he got arrested. He was found guilty because of tax fraud. So now he tried to find a way, how to avoid paying tax legally, because he still thinks that his tax money will be used by government to help pillage out there. After he's free from the prison, of course. So basically, tax equals everyone contributes a little so society can work better. But I think you don't like paying taxes, and it seems unfair. Make small money and still need to pay lots of taxes, while some rich dude's publicly saying that they don't pay any taxes. For the moment you all waiting for, how the rich avoid tax without getting arrested. This method is called tax avoidance. And one of these methods were actually used by billionaires like the smartest investor, Warren Buffett, and the founder of Apple, Steve Jobs, and also the recent US President, Donald Trump. What is tax avoidance? Tax avoidance is about using smart, legal strategies to pay less in taxes. It's like finding little loopholes or taking advantage of tax deduction and credits that make the law allows. While tax evasion can lead to fines or even jail time, tax avoidance is considered clever financial planning. So instead of breaking the law, you're just using the rules to keep more of your money. Let's break down how tax avoidance works with some examples. The first trick is using dividends. As I mentioned before, Warren Buffett, one of the successful investors, pays a lower tax rate than his secretary. How does this happen? Well, because his income mainly comes from dividend and long-term capital gains, not salary. Dividends and long-term capital gains are taxed as lower rates compared to ordinary income. For instance, while a $100,000 salary might face a tax rate of 22% to 24%, $100,000 in qualified dividends and capital gains is taxed at just 15%. This tax advantage allows Buffett and other wealthy people to pay less in taxes on their income from investments, which are treated more favorably by tax laws. The second trick is transfer pricing. Transfer pricing is when a company moves money between its branches in different countries. It sets prices for things like products or services to make profits show up in places with low taxes. This way, companies pay less tax overall. For example, let's say Steve has a company named Big Chest Corporation in the United States. His company just sold a new model of chest plate and made 1 million emerald dollar. Let's assume the US corporate tax rate is 35%. Normally, he would pay 350,000 emeralds in tax and keep 650,000 emeralds in profit. But instead of paying this 35% tax, Steve decides to use a tax haven like Cayman Islands, which has 0% corporate tax. So Steve sets up a subsidiary in the Cayman Island called Big Chest Cayman Island Corporation and transfer all the Big Chest Corporation parents and copyright to this subsidiary. When the US Big Chest Corporation sells a new model of chest plate and make 1 million emeralds, it claims it need to pay 800,000 emeralds to the Cayman Islands subsidiary for using the Big Chest brand's patents and intellectual property. This leaves only 200,000 emeralds in the US to tax it at 35%. So the company only pays 70,000 emeralds in US taxes and no taxes in the Cayman Islands, keeping 930,000 in profit after taxes. This saves Steve 280,000 in taxes. However, Steve can't bring this 800,000 emeralds from the Cayman Islands back to US without paying taxes on it. So, what would Steve do? Steve can reinvest the money outside US or wait for tax reform. For example, in 2018, the US corporate tax rate changed from 35% to 21%. If that happens again, Steve can bring the money back to the US at the lower tax rate. If Steve decides to bring the 800,000 emeralds at the new 21% tax rate, he would pay 168,000 emeralds in taxes, keeping 632,000 emeralds. This way, Steve ends up with 762,000 emeralds after taxes, compared to 650,000 emeralds if he had paid the initial 35% tax. The third trick is using controlled foreign corporations, or CFC. A CFC is a company set up in another country where taxes are very low or even zero, known as a tax haven. By doing this, people can move their profits to this foreign company to avoid paying high taxes in their own country. A real-life example is Apple. Yeah, the company that makes iPhone that maybe you use for watching this video. Apple avoided paying huge amount of taxes, about $44 billion, in just 3 years from 2009 to 2012, by setting up shell companies. One of the first shell companies was called Apple Corporation Euro in Ireland. This company didn't have any employees, but it was incredibly beneficial for Apple. So, how does this shell company work? Ireland's tax laws recognize a company's tax residency based on where the company's management is controlled. On the other hand, U.S. tax laws recognize tax residency based on where the company is incorporated. Apple took advantages of this difference. By creating company in Ireland, the U.S. didn't tax the company because it was incorporated. Additionally, by having management control in the U.S. instead of Ireland, Apple avoided Irish taxes. In summary, tax evasion is illegally avoiding taxes by lying or hiding money, while tax avoidance is using legal methods to reduce or even avoid tax bills. While tax evasion is risky and illegal, tax avoidance can be a smart way to handle your finances within the law and provide benefits. It's also important to note that some strategies people are tax avoidance are actually tax deferral. Tax deferral means you are just delaying tax payments but still need to pay the same amount eventually. For example, contributing to 401k retirement accounts, using 1031 exchanges for real estate, IRA, and others. These strategies delay taxes to a later time, unlike tax avoidance, which aims to reduce the overall tax bill. If you want to know economics from your favorite game language because you have that monkey brain, please like and subscribe. Thanks for watching and see you guys in another episode.